Hey everybody, it's good to be here today. My name is Brent Morris. No, I'm not the normal presenter in this class, but Brett is out and I'm in, so glad to be with you. I'm also glad to be joined by Cameron May, who's helping me out today in the chat. So as you have questions, feel free to type those questions in the chat, and between Cam and myself, we'll do our best to help you out. You know, the topic is short verticals. We'll talk about short verticals today. Both Cam and I have been dealing with short verticals for over 2 decades now. We've been working together on those, and I appreciate his knowledge. I've learned a lot from Cam over the years, and I encourage you to check out his webcast, including a dividend webcast he teaches each week. He did that just a couple hours ago, so make sure you check that out either live or on the recording. And hey, familiar names in the chat, we're glad you're here too. You can follow Cam or myself on X at Brent Moore CS, at Cameron May CS. Cam also has a LinkedIn account that he has out there that you can follow him on too. Let's get to it in just a sec. I want to talk about the markets and volatility and looking at short verticals in the current markets. We'll do that, but first, I need to go through a few disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as the sole means of investment research, and the paper money application is provided for educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. And, when trading options at or near expiration, you need to consider risks specific to the strategy, such as lack of liquidity, significant price slippage, and volatility. And that tends to occur more as we get closer and closer to expiration. So I'm not planning on doing any super short-term trades today, but just realize that's kind of the inevitable thing that happens with those options as they get close to expiration. Stop loss orders will not guarantee an execution at or near the activation price. Okay, let's head on over to the Thinkorswim platform. Take a look. Here's the S&P 500. And we've had a nice little rollover in this. You know, for a little while, we were looking at, the trend was kind of weakening, but seemed like we were still kind of holding up about that 6,800 level. Well, no more. We're down below that. We had the 20 and 50-day crossover here on the chart, and our moving averages are sloping down. We have lower highs, lower lows. And so it's just, things have just turned south. Part of it is obviously the war, and that is affecting not just the S&P 500, it affects the whole market. It affects oil prices, and here's a price of crude oil. And, you can see we're up at $94 a barrel here. We're not going to trade this. This is a future, but we're not trading futures. So this is just to look at the price of oil. Interestingly, you may even look at the price of Brent crude. Brent crude's, it's actually a little bit, it was over $100 earlier today. And it's now at 98. So in any case, obviously that it has spiked. And along with the spike in oil, along with the dip in the S&P 500 and the Dow, we could look at other indexes. They're all going to be down pretty much, those major market indexes. One thing that's not down, though, is the VIX. So here's the VIX. Let me get rid of this white line because that's, I was showing something yesterday on that. But here's our VIX. We're up at about 26 on the VIX. Okay, so what's the VIX? VIX is implied volatility. It's just a measure of how expensive options are. Options become more expensive when option premiums are higher and people are more nervous about the market, when they expect more volatility in the market. Well, people expect more volatility when they're jittery or, often when the market's falling. Well, all those kind of conditions apply right now. So options are more expensive. And so from that standpoint, short verticals can actually benefit from that if options are more expensive because we're selling them. Now, a lot of you guys have heard that. You sell options, perhaps, is what you've heard when option premiums are expensive. Well, that doesn't do you much good if you have a volatility and you sell those options, presumably for more than you normally would be able to, and then the volatility just keeps going up. Okay, that doesn't help the situation there. So it's not a foolproof plan just selling options when premiums are high. The theory is, though, this. The theory is that if you look at implied volatilities, here's our implied volatilities, here's the VIX. They spike, but often they come back down and kind of revert to the mean. We kind of call it a mean reverting asset there. Now, sometimes it can stay elevated for quite a while. So I don't know what the future holds. Part of it's probably just going to depend on the future of the war. And I have no better idea than you do what the future of shipping in the Strait of Hormuz is going to be like in the future. So those are the kinds of things that are going to affect us. But those are considerations, and one reason why short options are often attractive to people right now is because of the increased implied volatilities. Let's take a look at a stock here and just do an example here, because I want to show you there's a few factors in here. Here is Chevron Texaco. Obviously, this is going up. Well, let me just do a 6-month graph. Bounced off the 20-day. I don't know how high this is going up. This is obviously one of those companies that benefits from oil, the energy spike, right? Oil prices. And for all I know, this could just reverse itself, but I'm going to go with the trend. I'm going to assume that this is going to continue to do well going forward. And so I'm going to look for a short vertical on this. There's different ways to decide when you're doing a short vertical why you would do it. I mean, you could just kind of have a theory, a macroeconomic theory, and say, I think oil is going to stay elevated. I think oil and gas companies such as Chevron Texaco they're going to perform well. That's not going to change itself soon. If this is your theory, I'm not saying this is exactly what's going to happen, but I'm just saying if that's your theory, you may decide to do a bullish trade. Maybe you take a technical analysis approach. Technical analysis approach, the trend is going up. 20-day moving average seems to have acted as support. We have higher highs, higher lows. I'm going to assume it's going to continue to go up. If we do a bullish short vertical, it's going to be a short put vertical. I'm just going to abbreviate SPV. You have a short put that you're going to sell, and you have a long put you're going to buy at a lower price. I'm going to put a little plus for the buy, a little minus for the sell. And typically, we're going to do those out of the money. Okay, so we'll put a short put down here, and we'll put a long put at a lower strike at some point. How low? Well, you can do different things. You can say, well, I think this was kind of a potential break above there. I think it's going to stay above there here. And we can aim to put our short put at the 190 or less, maybe. Just an example. There's other ways you can do it. And you can use kind of more probability-based measures in terms of strike selection. In other words, if I go to the trade tab and bring up Chevron Texaco, I can look at, we're going to go out about a month here, maybe. Let's look at April 10th. That's 29 days. And I'm going to look at my puts here. Ooh, look at this, though. Look at my bid price. We said 190. And my ask price. There's my bid price. There's my ask price. It's about 85-cent difference there on a $3 option. That's, a 20% difference or so between the bid price and the ask price. I think for probably most traders, most options traders, that is too big of a gap. Most options traders would say, well, we can't do that trade. The bid-ask spread is too big, and therefore it's just not liquid enough. We're not going to get decent pricing on that. Well, one thing is this. These are weekly options. If you're using weekly options, your spreads are typically, not always, but typically not going to be as good. So I'm going to go to the monthly options. Okay. So Chuck in the chat said, look at monthly options. Spot on. Let's look at the monthly options. Here's the monthly options. Let's go to that 190 strike. Oh, look, 25 cents. Now we're less than a 10% difference. We're closer to like a 5% difference, closer there on that. So, on probably most, I would say most stocks that you're doing options on, these monthly options are probably going to be more liquid, often a better opportunity there in terms of better case can be made with the liquidity there on that. Now, if you're trading NVIDIA or Apple, the reality is they trade so much, you're probably, I guess I can't make any guarantee, but you're probably going to see pretty good liquidity even on the weeklies there, just because they're so traded. But even Chevron, which is obviously a big company, you guys have all heard of Chevron, you all know what Chevron does. The liquidity isn't always straightforward. So that's what we're going to do. Now, I mentioned you could use these kind of probability measures in terms of deciding strikes and whatnot. And so what I'm going to say is this. I'm going to use delta. Delta just tells you how much that option price is going to move in relationship to a $1 move in the stock price. Okay, that's the kind of textbook definition of delta. However, we're going to use it for another purpose. We're going to use it for a kind of an idea of the probability of it expiring in the money. Now, we could add a separate column here and look for probability of expiring in the money. They're not going to be exactly the same, but if I do this and I go probability in the money, you can look and you can probably say, well, look, 12, 13, 16, 18, 22, 25, 31, 34. They're close enough for our purposes here today. You can use the delta, you can use probability in the money. I'm going to look for something that's roughly 30 to 35% there on that. And so I'm going to go to that 190. Now, it may not, you may have caught that 190 with the delta, which is 30 to 35%, happened to correspond kind of where I said, well, let's look for that support price there. If they're out of whack, you may consider not making that trade. In other words, there are different approaches. You can just say, hey, I'm going to just use the delta. I'm just going to kind of use our probability in the money or something like that. I'm not even going to pay attention to the technical analysis or support levels. Some traders do that. But very often, and what more often than not, I think you'll find most of us teach is you can look at technical analysis along with this at the same time. So here's what I'm going to do. Let's look at that trade here. I'm going to sell the 190. I'm going to buy the 185. I can look at it that way. I can also go up here and go to spread and go to vertical right here. 190, 185 right there. Okay. And what I'm going to do is I'm going to go up here and I just want to play around with it a little bit. Let's look at the Theo price. I'm going to click right here. And I'm going to select Theo price. And we can kind of, let me reset this. I'm just going to kind of estimate what the trade is going to look like if the stock goes up or down or sideways. So we're going to look right over here. I'm going to look at the mark price and the Theo price. Right now, they're about the same, okay? But what if the stock, we'll say it stays the same. Okay? I'm going to say it stays the same from March 12th. We'll go out a week, okay, to March 19th. I'm not going to adjust my stock price because we're saying it stays the same. But we're going to say a week goes by and implied volatilities, which are now around 33%, go down just to maybe, well, actually, before we do that, let's just look. What would a week's time do to this trade? Well, let's see. We said 190, 185. Not a lot, a little bit. Mark price goes from 126 to 118. Okay? So the time decay itself would benefit us a little bit. Now, you may be saying, Brent, that's not as much as I expect. Okay? We could go even more time. Instead of March 19th, you can go to March 26th, 2 weeks of time. Let's see what happens. Out of the money, mark price 126 to 105. Well, that's a little more. That's a little better. But there's something you need to keep in mind with short verticals, whether they're short put verticals or short call verticals. Remember, there's two legs. There's a short put and there's a long put. The short put, in terms of, say, theta or time decay, the rate of time decay, the short put is going to be, it's going to benefit us. It's going to be positive theta. Time decay helps us out. The long put, the time decay is going to be negative. It's going to work against us. What about that implied volatility? Well, because with theta, we know time's going to pass. It goes straight forward. Vega, we don't know whether it's going to go up or down, but in terms of vega, the short put would benefit if we get a drop in implied volatilities. The long put would actually do better if we get a drop in implied volatilities. Sorry, I said that wrong. The long put would benefit if implied volatilities go up. Here's my point. These don't totally cancel each other out. I mean, you can look at this and go plus a positive number and a negative number are going to cancel. No, they're not. It's going to depend. The impact is going to depend which has the greater impact, which has the greater factor. But there's certainly not going to be as much as just doing a short put alone as not a part of vertical. The theta is going to be less than that because we have that long put there. Now, which is going to be the bigger factor? Typically, we do these out of the money. If you do these out of the money, then the short put is going to typically be bigger, okay? Because the stock price is closer to the short put. If you look at a option chain and you look at vega or theta, or excuse me, if you look at theta, for example, and you're looking at which contract is going to be most impacted by, have the highest theta, the ones that are at the money or the ones that are closer to the money. If we're doing them out of the money here, the short put is going to be closer to out of the money, to being at the money. So what is vega is the question. Vega is a measure of how much that implied volatility, remember we started off talking about implied volatility, how much that is going to affect the price of the option. Let's do this. Let's look back at this trade here. And we'll look at vega now. We said, given the 2-week time frame, no stock price movement, what happens to that trade? Well, our mark goes from 123 down to 103. Well, let's see what happens if implied volatility, we'll say it cooperates in this case. Now, I'm giving you a good scenario. Things can work against us, and we'll look at that in a sec. But let's say that implied volatility goes down maybe 4%. I'm going to put a -4 there. I put that in. And now, instead of 123 and I think it was 103, it's now down to 88. So there's a few things I want you to get out today. One, you can use this Theo price tool to double check and kind of estimate. It's not a guarantee, but it's an estimation of what your options are going to do. Not only based on stock movement, we actually didn't even change the stock at all in this case, but you can do it based on the date, the time decay, how much theta is going to affect it, or impacts of implied volatility, how much implied volatility is going to going to impact that. Now, I gave you a good scenario. Let's say that it's not such a good scenario. Let me reset this. And it's 2 weeks, but our stock that we think's bullish goes down $5. Let's go -5 on the stock price element here. Let's see what we got here. We go from 123 to 170. We're selling it for 123 up front. To get out of it at that point, it's going to be approximately $1.70. So that's not a good scenario there. So this is a bullish trade. Sometimes you'll refer to it as a neutral to bullish trade, because if the stock goes sideways, we get those benefits of time decay there. But there's a trade. That's a bullish trade. You can do bullish verticals. You can do bearish verticals. Let's put this in our paper money. I'm going to just click on the bid price here. And I'm going to move it just a little bit off the mid, just because I don't think it's probably going to fill at the mid. And I'm going to we'll do 2 contracts. Let's do 2 contracts here. I'm going to click on confirm and send. And I'm going to put that in my short verticals group. And I'm going to send that trade. That's an example trade. And I encourage you in your paper money, not your real money, in your paper money, to follow along, place trades. That's a way to experiment. This is a bullish example trade. I don't know if things are going to continue to be bullish, but this would benefit. Like if I look at implied volatilities, this would benefit if implied volatilities go down there. Okay. Now let's look at a kind of more of a bearish example. And again, this is probably kind of tied also to the whole world situation right now. Cruise travel, Norwegian cruise lines. Well, I'm going to take more of a bearish stance on this. Not only have we been falling, kind of almost, to be honest, a bear flag. Okay, that kind of pattern. But macro view, well, if crude oil prices, which impact margins clearly on cruise travel, if international travel becomes less likely for people, maybe fears or whatever, I don't know, then this may have more of an extended downward move. So we can do the technical thing, we can do the kind of macro view and look at it from that standpoint if we want to. But I'm going to do a bearish trade here on this. This would be, instead of a short put vertical, this would be a short call vertical. A short call vertical, we're going to sell a call. We're going to buy a call. Now you're going, Brent, why'd you say LC if you say buy a call? Wouldn't that be BC? LC stands for long call there in that case. All right. So that's the plan here on this. Okay. Now technicals. What about resistance? Well, potential. Seems like a kind of right there, maybe. I'm going to call that kind of a resistance level. Where is that anyway? That's what did we say, right around there? Around 20.5 or so, maybe 21. Let's look at a potential trade here. I'm going to go Norwegian cruise line. It's kind of same deal. Monthly options are probably going to be more liquid. Let me get out of this vertical here. Single. And I'm going to look at the call side of things. And we're at, let me actually go back to Delta. Here's Delta. I can go to 34 Delta. That's a 22 strike. Okay. And buy a 23. So I'm going to look at the 22 and the 23. Now, if I look at these, there's not that much difference between, they say look at the exact same thing. If you had more decimal points, what I think you would find is there's actually a little bit higher. It's a little bit higher probably on the 22 than the 23. Notice, though, to my earlier point, when you're kind of at the money, that's these contracts here, your theta and your vega are going to tend to be higher than if you start to go in the money a ways or out of the money a ways. You don't really see it very well on this one because I would need more decimal points right now on this, but it kind of rounds the numbers there. But trust me on that one, okay? So this would be a positive theta trade, but it can also, and a negative vega trade, but I don't want you to emphasize the theta and the vega here. They are considerations, but the stock price needs to cooperate. If this stock goes up, this trade probably is not going to work out, regardless of what the theta or vega is. So I'm going to go and I'm going to, now I could do what I did before. I could go to vertical and look at it like right here. That's the two together. But if I look at single and go here, I could look and I can look to sell that one. And then I can click to buy on this one. Before I click on buy though, I'm going to click on my control key, because if I don't click on the control key, it's going to just swap out the 22 for the 23. It's going to overwrite the 22. By holding the control key down, it says, let's do both here. Okay. All right. Barbara asked a great question. Talking about implied volatilities, or perhaps just the volatility of a stock in general. Does it depend mostly about news, about the stock, the sector, or the market? The answer is yes. I know that's not your question, but think about it. News about the market as a whole is probably going to increase implied volatilities for most stocks out there right now. Some sectors, or some, say, industry groups, travel, are going to be more impacted than others. I suspect the changes that you see in Norwegian Cruise Line are going to be the same in terms of implied volatility, or pretty close at least, to Carnival Cruise Line or something else, right? So it can be any of those. And so that's, but it's the market volatility is going to affect some sectors, some industry groups more than others, no doubt. All right. So there we go. Now, when you're doing these, you can also consider another consideration. You could say this is, we're at about a month here on this one. Let's see, April 17th is our expiration. So just a few days over a month. And you can click on confirm and send. I'm going to do more contracts, except I clicked the wrong way. We'll do about 4 contracts here. Okay. So one thing you can figure out is this. Now, this is a higher probability trade. On average, given the strikes that we've done, it's more likely this would turn out to be profitable than not profitable. However, we're risking more than we're risking more than we potentially are making on this. So that's something for you to consider. It's not just probability. You know, I've seen people advertise, like one of these on social media. Hey, I have this trading system. It's with 90% win rate. And to the uninformed, they may get duped into jumping at something like that without thinking about it. Even if it's true that they had the 90% win rate, you got to take into account your return on risk. Okay, you got to take into account your return on risk on these trades. And so here we go, 96. I'm just taking a calculator here. 96 divided by 304 gives me about a 31.5. We'll say 32% return on risk. Okay. That's a pretty typical one for something, an out of the money vertical that's kind of in that 30-ish delta range. That's pretty typical there on this. Higher probability, worse return on risk. If I instead of doing the 22, 23 strikes, if I did the 21, 22 strikes, what would I see? Well, I'd get a bigger premium. That's nice. My return on risk would go up. It'd be better, but there's more chance I wouldn't win. Just to me. Yeah, I kind of said that in a funny way, but there's less of a chance that it was going to be a profitable trade in that case. So there you go. There's that. And I'm going to, now, we're not going to do this trade unless we think the stock's going to stay below 22. If you do a short call vertical, you want the stock to stay below 22. That would represent max gain at expiration. So, for example, let me go back here for a sec. If I look at this 22.23 and let me do vertical 22.23, if I change this to Theo price and say it stays below, even if the stock goes up, let's say it goes up $1.50 on me. That's not the way I want it to go, but let's say it goes up $1.50 on me. Initially, that's not good news on this. Let's see, that's today, okay? Initially, that's really bad news. If I look at that 22.23, my mark goes from 23 cents to 36 cents. But as we get closer to expiration, expiration was the 17th. Let's go right before expiration. Even though the stock went up on me, the price, that's 6 cents. Gives you a lot of decimal points to kind of throw you off maybe a little bit. But you've made almost all you can make on that trade. So that's time decay. That's the impact of time decay. The nice thing about time decay and looking at theta and stuff like that is, you know what time's going to do. Time ticks one day at a time, right? Like the sands of an hourglass, as the old soap opera said, right? We know time's ticking forward. We don't know what implied volatility is going to do, and we don't know what the stock price is going to do either, but you got to have a kind of a theory, at least on the stock price aspect of it. So let's do that trade. I'm going to just confirm and send, and I'm going to put that in our short verticals bucket. We're going to send that order, and there we go. Now, it's thinking. When you put a trade, here's NCLH. When you put a trade into the Thinkorswim desktop software, if you put a single order in, like just a long call, or just a short put, the default is to put it in at the natural price. So on the long call, that'd be the ask price. On the short put, that would be the bid price. If you do a vertical spread or any other spread, the default is to put it in at the mid price. You're probably not going to get filled right away at the mid price. Now that one just filled, but that's because it probably just took a little bit of favorable price movement on that. So that's no longer a working order there on that. But that's that. So there you go. Okay, question from Barbara. How accurate is the Theo price generally? Here's my take. First of all, I have no scientific data to give you on how accurate the Theo price is. But keep in mind, you have three big assumptions here. You have the stock price. You have time. You have volatility. if you were to be able to estimate, if you were to be able to hit these spot on, then it's pretty darn accurate, I think, in that case. The challenge isn't with the accuracy on the Theo price tool. The challenge is the accuracy of your forecast and what's going to happen in the future. And we just don't know what's going to happen in terms of stock price or volatility in that there. So good question, though. So let's move forward. Let's give you another example trade, at least one more here today. Let's do another one. Here's EQT. Here's EQT. Here's your 20 and your 50-day moving average. Nice trend, right? If we're doing technical analysis, that's classic trend. Higher highs, higher lows. They're going to continue? I don't know. But what is EQT? Maybe you aren't familiar. How do you know if you don't know what something? Go to the Analyze tab and go to Fundamentals tab, sub-tab, and you can scroll down and you can see EQT Corporation engages in exploration, production, gathering, and transmission of hydrocarbons and natural gas. Hey, energy, okay? Energy sector, you can see that right there. That's the sector, energy. Using kind of our theory that the current world events are going to have a longer lasting impact on some sectors than others. Energy is one that would tend to benefit. We can go with that theory. We could also go with we're going to use technical analysis theory as well. Okay. So let me go to the trade tab. There's EQT. Let me go back to single. And I'm going to look at these. Again, we can look out at the weekly contracts. I suspect they won't be great. We're doing puts here, put vertical. As I look at these, let me go to Delta. Delta 30 to 35. Yeah, that's getting kind of wide on those spreads there. Now, if you want, you can also look at open interest, and you can look at the open interest here. Not a lot of open interest on this guy either. Let's go to those monthly contracts. Do you see why the bid-ask spreads may be tighter on the monthly contracts? Look at the open interest here as compared to here. That's your correlation there. Okay. Now let me go delta. Delta, I'm going to go 33. Okay. I'm going to click on the bid price. I'm going to right click. No, I'm not. Excuse me. I'm going to control click on the ask price. That brings up the spread, $2.50 spread. Do I think the stock is going to be above 62.50? My suggestion to you is you go to the chart, you look at that chart, and you go, hey, my short strike, the one I want it to stay above is right about here. Do I think it's going to stay above there? We don't know for sure, but if you think it's likely to stay above there, and this, by the way, could be kind of a new support level. That's where we bounced off of there, and now we're well above it. And if it retraces, hopefully it would bounce off there again. But if you don't think it's likely to stay above there, then you want to do the trade. This is why these short verticals are considered, a short put vertical would be bullish to neutral. If the stock goes sideways from here, we're probably okay with the trade. Stock goes up, probably going to turn out okay. Stock goes sideways, probably going to turn out okay. Goes down a little bit, you're probably okay. Don't want it to go down a lot. And because this is we'd consider this a higher probability trade. There's more scenarios where things can go well than bad on us. But because of that, if it does go significantly down, we can lose a lot more in this scenario than we would win in these other better scenarios there in that case. Okay, let me go to trade. Let me go to, I'm just going to do a couple contracts here on this. Notice, I mentioned before, it comes in on the mid price. Realistically, I could put it in at the mid price and it may fill, it may not. If it fills, it's probably because of the stock moving after I submit the order and we're getting more favorable prices there on that. I'm going to move it between those two, okay? And I'm going to click on confirm and send. And we're going to click on this for another short vertical. Okay, everybody. So what I wanted to show to you today is this. I wanted to give you numerous examples as well. We did 2 bullish examples, short put verticals. We did a bearish example on Norwegian cruise lines. We talked about implied volatilities. We talked about using that Theta price tool to your advantage to better understanding your option trades. We showed you how to actually manipulate or use that Thinkorswim desktop software to place your trades. I'm encouraging you to paper trade these, and so you can learn more about them. Don't do your real money until you've learned on your paper money. Also, I'd encourage you to check out some of our other webcasts. We have a whole variety. They're on the Trader Talks channel. All you need to do is go to YouTube. You're probably on YouTube right now, watching me right now. Bottom right portion of the page, you should see an opportunity to subscribe if you have not already subscribed. Trader Talk Schwab is the channel. Once you've subscribed to the channel, it's kind of neat because you can just go to the channel and then you can go, there's different tabs. There's one for like new videos and one that has playlists on it. And you can see the variety of different webcasts that we teach. Also, make sure you follow Cam and I on X, at Brent Moore CS, at Cameron May CS. And I appreciate each of you. Coming up next, we have Trading with ThinkScript. That's a great class. Make sure you check that out. That's at the top of the hour. In the meantime, thank you, Cam. Always appreciate Cam. And thanks to each of you for joining me today. Have a wonderful rest of your day. And we'll see you down the road here. Bye-bye, everybody.